Hello, I'm Jeremy Allaire, and this is The Money Movement, a show where we explore the issues and ideas with this brave new world of digital currency and blockchains. This week, we are going to continue on this theme of digital dollars. And, this is a theme we've been exploring now for months. And as you're going to hear today, we're going to talk about crypto dollars, not digital dollars. And we'll talk about what the difference is and the meaning behind that. But obviously last week and in earlier episodes, we've talked about stablecoins extensively. We've talked about future central bank digital currency models, hybrid central bank digital currency models. We've explored the role of the private sector versus governments operating and administering some of this themselves. What is that balance and set of trade-offs? But this week, we're going to turn our attention to another lens on this, what Castle Island Ventures co-founders Nick Carter and Matthew Walsh dub crypto dollars. So over the past few years, I've gotten to know Nick and Matt a bit, and early this year, sat down with them for a bit of a deep dive on the whole stablecoin space, and was really intrigued with the conversation and the thoughtfulness that they had about this problem space. And then later this year, Nick and Matt penned a fantastic piece, which was published in July, which is linked in the show description, dubbed Crypto Dollars, The Story So Far, which I think better than most analysis really dove into the very profound and long-term implications of this innovation on society and in general, kind of the birth or perhaps rebirth of a free banking era. Really, really fascinating discussion. So I'm actually very thrilled to have Nick and Matt on the show. Welcome, guys.
Thanks for having us, Jeremy. Excited to be here.
Yeah, excellent. Hey, Matt.
Hey, Jeremy, great to see you. Thanks for having us on.
Yeah, absolutely. You got a great mic there, Nick.
Thank you. It's just you do so many of these, and you have to make sure you have quality equipment as well.
Yeah, no, I know. Awesome. Well, I'm super excited about this conversation. So maybe just kind of kicking off. You have this. I think you have a high level thesis, and in the work that you guys have put out, and I, obviously in listening to a lot of other conversations that you're having as well on your own podcast and out in the world, you talk about crypto dollars, and you talk about crypto dollars as being very distinct from digital dollars. I think there's a lot of different conceptions, misconceptions, stable coins, digital dollars, central bank digital currency, and crypto dollars. My feeling, of course, is that you have a very specific meaning when you talk about crypto dollars. And so, maybe just first, what's the high level thesis that you have around this idea of crypto dollars?
Well, I guess I can kick it off there. I mean, our view on the phenomenon is really that it's the most impactful thing happening in the crypto industry in 2020. And it is, building on the shoulders of giants. I don't think crypto dollars would exist if Bitcoin didn't exist, for instance, or if crypto exchanges weren't so ubiquitous, or wallet technology hadn't reached the level that it reached. But in some ways, this feels a little bit like the apotheosis of the crypto phenomenon. That's not to discredit Bitcoin or any of the commodity-like cryptocurrencies, but it's just pointing out that crypto users seem to have a revealed preference for using crypto dollars, just empirically looking at the data, looking at the transactional activity. So our view on this is that it's satisfying a really important demand that has existed for a long time and is now possible to meet those expectations, which is effectively unencumbered commerce, more global, more natively seamless commerce. And I think the key differentiator for crypto dollars is that they are, I think encumbrance is the key, is that they give you more transactional freedom, more transactional autonomy. And then there's some other really nice qualities like settlement quality and things like that. But at the core of it, in our view, is that they combine the high quality settlement assurances that you get from cryptocurrencies like Bitcoin with the low volatility characteristics of fiat. And so it's a pretty happy marriage so far.
Yeah, totally. I mean, I think when I first started using Bitcoin and playing around with public chains in 2012, if you're a crypto user, you had these aha moments of like, oh my God, this is this permissionless settlement. This is software. This is all the security dimensions to it and all these other things, and it changes forever. I think your experience of money, it's just this different level of freedom and use and utility and other, and sort of it's this marriage of the internet and money and software, and so that like I think is in some ways, like if you already deeply understand the inherent benefits of cryptocurrency, of the digital currency like that, yeah, of course, if you're going to have a dollar version of that, that's awesome too, right? So the sort of preference that emerged within the ecosystem to use that, I certainly, as you know, that inspired a lot of the work behind Circle. But I think there are coming back to maybe where I started too, which was there are all these different definitions, concepts. If you talk to a lot of people, they couldn't really differentiate them that well. Obviously, you guys are incredibly deep in the space, but maybe talk a little bit about that segmentation a little bit, right? Matt, I don't know if you want to take this. There's sort of different concepts and definitions, and I think because we really want to focus today on crypto dollars, like maybe we can say what's not a crypto dollar.
Yeah, definitely. Well, maybe I'll just opine a little bit about what you were just talking about in terms of how we got here first, and then Nick can talk a little bit about how we think about the segmentation. But I was thinking back last night, getting ready to do this around the first time that I met you at Fidelity, and sort of the original idea behind Circle, and how in a lot of ways right now what's happening in the industry is exactly what you sort of predicted would happen. I think the implementation details have shifted now.
Totally.
So, if you think about those early days, we thought we would be doing a lot of this on Bitcoin. And there was a big push around colored coins and the open assets protocol. And would this be a proper conduit to actually get some of these crypto dollars into practice?
Yeah.
And then, I guess we all know what happened there. And we end up with the ERC-20 standard, end up pushing this along. So the way that we're sort of looking at the space now is that there's various different trade-offs and implementation details around how you access this market. Nick, do you want to talk a little bit maybe about the kind of the framework and how we segment the market?
Yeah. You asked earlier about, what's the difference between a digital dollar and a crypto dollar? And I think that gets to the core of it really. Digital dollar always confused me a little bit because it seemed a little bit redundant, to be honest, because most dollars are liabilities of the commercial bank system and they exist in digital format. In fact, the overwhelming majority of all of the instruments that we refer to as dollars are totally digital. I guess there's a couple trillion in physical cash.
There are electronic records for them.
Right.
Right.
They're not electronic bearer assets per se, but they exist in digital format, solely in digital format. So I guess you can convert them into cash if you really wanted to. Physical cash, but for the most part, they exist electronically, which is why we chafe a little bit at the digital dollar conception or appellation. And I know crypto isn't the most popular prefix. People kind of associate it with insalubrious activity and so on. But to us, it's a more apt way to describe the phenomenon and carve it out relative to dollars that exist in the bank sector. And I think the key differences are that crypto dollars aspire to be digital bearer assets, something that if you know the private key, you are presumed to be the owner in the eyes of the blockchain. And that's not...
It's like it is a native digital asset, is a native data type, as it were, like on the internet, right? It's very, very differentiated, from, again, these sort of legacy electronic money.
and you can fully assign control with by broadcasting some data online without the reliance of a third party. So that, to me, that's what the cypherpunks wanted to create. They wanted to create digital cash.
Yeah.
If you go back and read the discussions, a lot of it's about dollar denominated or stable cash.
Mm-hmm.
It's not necessarily about volatile cash, which has all these additional assumptions about new monetary policies. Right. So I think that's part of the reason the cypherpunks, some of them rejected Bitcoin, because Bitcoin by definition was going to be volatile. Mm-hmm. Not that that's a problem per se. It's just that's not exactly what some of the cypherpunks are trying to create in the 80s and 90s. If you look at DigiCash, that was a stable instrument as well. So
sure.
To me, the bearer asset nature is like the really, really key differentiating factor.
I see that too. Obviously, I think that part of why people kind of go to digital dollar when referring to digital currency based versions of dollars, it's a little, you sort of watch this happen in the internet space. I remember, in digital media, for example, like you'd sort of say, hey, we're actually doing, digital media, digital video, or video on the internet, or all these things. And the satellite companies were like, well, we do digital broadcast. Like our satellite network is digital, and the cable companies were, no, we're doing digital video on demand. It's on our cable. It's entirely digital. I remember they'd market like it's digital television, or satellite radio became digital, and it was basically saying like they're using software-based protocols and packet switch data or whatever the hell they're doing to deliver those things, but they're still like closed, walled off, controlled, intermediated. They're not public on the internet. They're not able to attach to permissionless networks. They're not something that anyone anywhere can participate in, with music and sound and text and communications. Like the real distinction is when you are, in my mind, like something that is natively digital is on public networks. It is on the permissionless internet. It is attached to open source software reference implementations. It's sort of, and so for me, that's a huge difference. And I think in a lot of people's minds, digital currency does kind of represent that. The conceptual model is that. But I like crypto dollars too. So
The other thing is, Jeremy, is it's programmable, right? And so that's something that none of these quote unquote digital platforms that are not built on public blockchains can really ascribe to be. And so I think the surface area for the types of things that you can build on the internet just gets a lot larger by virtue.
Absolutely. Yeah. The mashing stuff up and the composability and the fact that it's actually built on, open software that people can connect to and so on is just tremendous. It's really tremendous.
Yeah. Well, our view is that this is not a debate between analog and digital. We've left the world of atoms behind. We've been in the world of bits for a long time. Right. It's who controls the network. Is it, is there one nexus of control, or is it distributed? Yeah.
So I guess in your paper and in the discussions that you've had, what makes sort of crypto dollar special? There's a set of attributes that you've sort of defined to say, this is what makes, this is what defines these. This is what makes them what they are, and presumably makes them really special. We touched a little bit on those, but maybe we could enumerate some of that and talk about it.
Yeah. So honestly, I don't think we've even fully understood what makes them special. There's probably more features that we're going to discover, but the three that we lay out are the permissionlessness, so the encumbrance or the relative lack of encumbrance, the fact that they operate on open networks, and the auditability as well, which is pretty underrated in my opinion.
Yeah.
Obviously, I'm a little biased because we spent a lot of time looking at on-chain data, which to me is still pretty magical compared with the amount of data we have about, you look at the data from the Federal Reserve Bank of St. Louis, there's some pretty interesting data there, but it's all kind of inferred and you can't really directly apprehend a lot of this information about the dollar. Yeah, and there's a delay, and you can't account for all the dollars in circulation. I don't know if they could even, determine how many dollars exist to the nearest billion, for instance. With crypto dollars, you can audit them to the last tenth of a penny, so that's a significant difference. We've already touched on the transactional freedom, but I think that's really, really key. And I think it's a different model from, say, PayPal, where PayPal is actively, evaluating the risk of every single transfer that happens on the network. This seems a little different to me. And then you have the fact that it's on an open network, and any talented developer can just build a product, effectively a smart contract, and deploy it to the world and not even have a relationship with their end users. And they can reference an existing contract, that's the composability thing, which is pretty magical once you start to think about it. And it just means that the pace of development is so much faster than the banking sector, which seems pretty sclerotic to us these days.
Yeah, Matt.
I was going to say, I think we're also just going to start to see a lot of competition on various axes of risk. And so there are some really fundamental trade-offs between using different types of stablecoins too. And so I think you're going to start to see differentiation based on the censorship-resistant properties of these networks. You're going to start to see differentiation based on some of these platforms are a lot more likely to have institutional participation. I would definitely put USDC on that platform. So I think the addressable market of just dollars that can participate on those networks will be a lot larger on networks like USDC versus something like
count dollar money markets, and imagine if more of that was on digital currency. Right?
Totally. Now the trade-offs versus using something like Tether, where we could argue whether or not that platform is fully backed, but certainly there would be censorship-resistant kind of trade-offs there between this more centralized project.
The interesting thing on that is people talk about blacklisting and stablecoins that have these censorship mechanisms built in, and I think it's been publicly disclosed that Center Consortium has approved one blacklist, but it turns out there's dozens and dozens of them done by Tether. Sometimes we don't know why, we don't know who. Is it done for a friend who lost some money on an exchange? We don't really know. There's no transparency. Yeah. There's no policy. There's no accountability. So it's not censorship resistant at all.
Yeah.
Yeah. I think I looked yesterday and there are 100 addresses blacklisted on Tether so far.
I mean, look, I think it does underscore the fact that I think what people perceive as maybe censorship resistant maybe isn't.
And I think the big question there in everyone's mind in the industry is what would happen in the event of enforcement action, and sort of what role would the parent company play, and how would they fight that? And then the last one is just, I think we're going to start to see a lot more experimentation around some of these algorithmically designed platforms. And the key risk there is just around whether or not they break and whether or not they can hold a peg. And so it's fascinating, just the innovation along all of those dimensions. And I think depending on the use case, you would gravitate as a developer towards one category versus the other.
Yeah.
On that topic of blacklisting, one thing I've noticed recently is it's pretty arbitrary who can get access to kind of like the rollback feature kind of thing. And you see people that lose money with Tether. Maybe there's a bug. If they are loud enough on Twitter, they can get the attention of the team behind it and get that transaction nullified and not lose their dollars effectively. But if you're a smaller fish, you have a lesser ability to kind of lobby. And so it's very vague and very unclear to me what the actual line of demarcation is, or what the protocol is for having these, having Tether itself overruled the ledger of record, which is the blockchain, which is not a great situation, I would say, for users.
Yeah, I mean, it's one of the reasons why Center Consortium publishes its blacklisting policy on the transparency page on center.io, and it's extremely clear that, basically, if the network is the fundamental security of the network is jeopardized, say, admin keys, privilege keys, things like that, obviously there would be a justification. But other than that, the language is very clear, which is a final binding court order from a competent U.S. jurisdiction presented to center consortium's governing body. That's pretty specific. Someone who's loud on Twitter that doesn't meet that criteria.
And that's quite a high standard to meet.
It's a very high standard to meet. It's a very, very high standard to meet. And I think it has to do with, how do you ensure that people can trust this as a reliable instrument? And I think, there may be policies that emerge in the future that are outside of us that define other things that might need to be in place. But right now, Center Consortium is a governance mechanism on this, and it governs a lot of different things. But one of those is that policy, and transparency is really key around that.
So I guess the higher the barrier to climb is to asking for a blacklisting, the just generally higher quality the settlement assurances are on the
That's
network
right.
itself.
I think that's exactly right. Yeah. Another theme, maybe just to touch on it, and there's so many things we could like dive off on and stuff, which is fun, but the subtitle is "The Story So Far" in your paper, and I agree with you. Like we are early in this story. I mean, most of the growth in this is literally in the last 9 months. Obviously there's been experiments in this for 5 years, but like the story so far is we're really, really early. Maybe talk a little bit about from your perspective, the why now. Why is this happening so pervasively right now? And we'll go from there.
I can hop in there first. Maybe Nick might have some different answers, but I think there's a few things that are really top of mind. One is that just the overall strength of the U.S. dollar as sort of the unit of account and the kind of the supreme apex predator of money on the global stage is really a big reason why there ought to be a lot of support behind things like crypto dollars, U.S. dollar-backed instruments. If you look at some of the movement coming out of China and just what that would portend to do on a geopolitical scale if certain types of transactions on a global level, commodity sales, for instance, were to be denominated not in U.S. dollars. So I think there's a lot of attention being paid from the higher ends of the U.S. government around that use case. Along those lines, kind of the story why now, I think there's a big move to be made here by some of the larger just payment providers in the United States. And so if you look at some of the PayPals, the Visas, the Facebooks of the world that all have teams and really smart people mobilized around this, I think it's seen as a next frontier opportunity that can really expand access to financial services in ways that you really couldn't do before this. And it can expand the aperture of what is possible when we get into some of these programmability issues, really look at some of these technologies becoming foundational for the next generation of internet services being built on top of them. And I think the third thing that I would say in terms of the why now is that there are a lot of just forces from a capital markets perspective that make this a really interesting new market to enter. So when you think about some of the opportunities just around the market structure here and the lending and the borrowing, you have a lot of firms that are moving in that are looking at this as a real extension of things that they're already doing in the capital market space. And almost look at the infrastructure behind US dollars hasn't been changed a lot in the last 50 years, right? And we have big industries there.
The base layer, every other function in the capital markets is kind of built up on that.
Right. And then, we have these well-functioning repo markets and money markets. And I think in a lot of ways, this is the next generation of that. And we're just at the very early ages here, but that is all getting built. And so when you think about stable coins and yield generation and some of these interesting things you can do, it's fairly obvious if you're a market participant what these, the addressable market here is huge. And so it's pretty clear that we're going to have some really large businesses built in some of these categories. And so I think that's another thing that's pushing this industry forward, this sector.
Mm-hmm. Yeah, I can chime in on a couple more specific things. I mean, first of all, we're just seeing this secular move towards people understanding how to use digital bearer assets for the first time. And before 2009, that was never a thing that anyone had to worry about, pretty much. And the technology didn't exist to facilitate that. And we had to start pretty much from scratch in 2009. And so it took a decade or so until we had the tools suitable to transact with value in the form of information. And that was a really difficult and challenging time. And a lot of people lost all their Bitcoins and so on, learning that lesson. And now the software stack has kind of progressed such that we can transact safely and not have to worry about it too much. And you look at the data, I mean, the Cambridge study says there's about 100 million individuals worldwide that have ever used a cryptocurrency of some sort. There's obviously caveats to that estimate, but I consider it to be fairly reliable. And 5 years ago, that figure was much, much less. So that number is just increasing. That's to the general growth characteristic of the industry. We've got a lot further to run, but that just means there's a much larger installed base of potential users for these things. So that's one reason why now, I think, is that there's just more people and more capital that's willing to allocate their assets to public blockchain-based digital assets. One catalyst that was very clear to us was after the shock, the risk-off event in March 12th. Some of the traders we talked to were firmly of the opinion that there were some crypto businesses that had their capital denominated in dollars, but not in crypto dollars, and they were unable to move fast enough to, exploit that situation where Bitcoin wicked down to, 3.5K or something crazy.
Right.
And so then after that, they realized, okay, we need crypto native liquidity.
Keep working capital on that. That's a trend we see. I mean, we see so many, blockchain native firms that are opening up accounts and who are, their use cases are first party payments and working capital, not just trading. And it's obviously this is like early adopter to some degree there, but it's clearly an interesting indicator. It reminds me of another thought. I was just asked a question. One of the things that's been interesting about, I'm just narrowing in on USDC for a moment. When you see USDC in circulation growing, it continues to grow even when the market goes down. It continues to grow when the market goes up. When there's low volatility, it continues to grow. And so in some ways people are saying, is USDC uncorrelated, or what's the correlation? Why is that? And that's something that we've noticed, obviously, as well. And there's some really interesting things going on there, which relates to your comments, which is, I think one was, when the investment asset markets are rising, more capital is coming into the market, right? So by definition, there's sort of more capital comes in. It comes in through tokenization. It comes in through things like USDC. And then once it's in the market, there's holders of it, and they prefer to hold it. It stays sticky because the people who've already decided they like crypto dollars, when they're receiving those on the other end of a trade or they're holding them, they want to hold them. So it generally stays sticky. But then when the market is selling off, people are selling into things like USDC, and they want to get out of whatever coin or whatever that they're trading, and they want to get into USDC. And again, they're crypto native, and so they're sort of saying, well, I'm just going to keep it in this, and then when I re-enter the market, I'll be able to do that, exactly to the example that you gave, Nick. And then the other is obviously the rise of DeFi and all of the protocols that are out there on the yield side. And so when it is idle, or when people are holding it, whether it's as working capital or investment capital or what have you, they can put it in a yield protocol and generate daily yield with instant liquidity that they sure as hell aren't going to get if they withdraw it out into native electronic commercial bank money. And so that makes it even more sticky. And so there's a little bit of a flywheel going on that. And then I think the thing that we're paying attention to is at what point does that go from just kind of working capital management into the sort of deeper forms of payments and settlement and treasury and other activities that firms have, where the advantages are so superior as well. And obviously crypto native firms get that. But when does that cross into, as you were saying at the very start, like this new form of commerce activity that becomes possible?
One of the interesting things there is the OCC stance recently around stablecoins, some of the clarity, and I know you've been doing a lot of work educating folks on that front. But to me, that just opens up the addressable market of deposits that are allowed to do these type of activities. And it's not just the DeFi for the yield. I mean, you can use Genesis or BlockFi to generate a much bigger yield than you would on a traditional money market. So to me, that OCC thing is really worth paying attention to, and we'll see.
Absolutely. Well, that's a good segue. So rise of DeFi, everyone talks about it. There's a lot going on there. We could decompose that into lots of different things. But I think the interesting thing is, and I'd love to hear you guys talk more about it, is this idea that, there's this programmability, there's this composability. Some of the first protocols that are programming underlying instruments like stablecoins are interest rate markets, credit markets. And when you think about layering of the financial system, like this is a really profound market infrastructure that's being invented and created here. And maybe talk a little bit about that. Matt, you obviously saw this from the Fidelity side of the house, where I think Fidelity is probably one of the biggest money market operators in the world. But as you think about, digital dollars, crypto dollar money markets, the growth of those, functioning of those, and it's obviously very related to DeFi. But how do you think about that?
So the way that I think about it, the way that we generally discuss it, is that there were really three foundational building blocks that had to be in place before we got to where we are now. One was around key management and custody. So how can you safely hold these things, either for yourself or on behalf of your customers? And so that has been built out pretty strongly over the past 8 to 9 years. We're to a point where you have large institutions participating, sovereign wealth funds, endowments holding these type of assets. Mm-hmm. The second thing was around the liquidity landscape, just around the spot landscape, and how do you move these assets around safely? So exchanges and OTC desks, and that's pretty well built out. Obviously, there's a long way to go, and the regulatory environment is catching up, and we're seeing a mix shift between the types of institutions there. And then the third really foundational thing that you had to have in place was just the data and the on-chain ability to query these systems and know that they were provably fair, and index construction and getting fair pricing and IOSCO compliant frameworks and things like that, just around the price of these things. And that's for Bitcoin as well as any other type of open crypto asset. But it's really on the foundation of the data, the exchange landscape, in the custody landscape that now you really start to see an unlocking in the capital markets landscape. So if you think about repos and money markets, some of these things that exist in traditional markets, we're just building that again right now, is my view, in the crypto asset space. And so this is a really compelling category, and I think we're going to start to see a lot more flows, just net flows moving into the system by virtue of this is already being built on top of plumbing that was built for Bitcoin and other crypto assets already, and it's institutional tested already.
It's interesting, Nick. What are your thoughts on these decentralized credit markets and interest rate markets?
Yeah, I don't know. I'm kind of in the Jake Chervinsky school of thought that true credit doesn't exist in DeFi yet. But not that, what's happening isn't interesting, but, he wrote this great piece saying, credit requires a notion of identity and, underwriting and analysis of a business or an individual's kind of cash flows and future earning prospects. So, I'm still thinking carefully about whether I want to say that credit exists in DeFi. I know there have been some small scale experiments there.
Certainly exists in CeFi using crypto and stablecoins and things like that. But
absolutely, yeah.
Making the identity and reputation leap and untethering the asset from collateral, which is unsecured lending, right? That's not
exactly.
Happening.
Yeah, so that hasn't happened yet. I wouldn't say we have quote unquote maturity transformation. You don't have classic banking activities that occur in DeFi. That said, you have these amazing interest rate swap products, and you have this collateralized lending, which is like taking out a line of credit against some equity that you hold without sending it, which is a very common tool in traditional markets, which has now been democratized through DeFi. Any asset that you hold that can have a price in an on-chain context, the price doesn't even need to be from an exchange, it could be from one of these kind of swap facilities. You could take the price from there. Now you can borrow against that and have, automated risk management. So those are some pretty interesting, and those are, in my opinion, the interest rate swaps, like compound and then borrowing against an asset that you hold. It might be a equity style, a pseudo equity asset. Those are the two most interesting things to me. The numbers are still really small in the grand scheme. I mean, you're talking about a billion-ish dollars of liquidity on compound.
Right.
I think the Forex markets are probably two orders of magnitude larger than that. So maybe more.
Yeah.
So we still have a long way to go, but I think some of the exchanges see where this is going. They see that these markets are just turning to foreign exchange clearinghouses.
Mm-hmm.
The most we see some of these decentralized exchanges specifically optimizing for trading stable coins.
Yeah.
They optimize so that the liquidity providers, can earn the return commensurate with the expectation that these assets are not necessarily that volatile relative to each other. So I think some of the utility tokens which powered this were truly the source of excitement. Some of those utility token theories are getting a little discredited, and we're seeing the growth of tokens which are equity-like, which is probably a bit more interesting in that it comes with more rights, and then just, fiat currency, representations of fiat currency on chain. It's weird that it's all dollars. It's 97-ish plus % dollars.
Yeah,
there's not a lot of other.
Talk about that, because obviously, again, you talk about crypto dollars. We talk about US dollar coin, et cetera. I think, from a geopolitical perspective, obviously, like all these countries around the world aren't just going to roll over and say, actually, everyone in my country can just transact in dollars, and that's all fine.
Some of them might.
Some of them might. So this is the question, just from a geopolitical economic perspective. The question I sort of ask is this going to be like the rise of the internet in earlier stages, where kind of the connectivity lit up, and then all of a sudden people are like, oh my God, I have global free communications, and I can just do it directly through my computer and then my mobile device, and I'm no longer bound by, as it were, like the rules of the regulated communication system in Italy or in pick your country, or like the borderless nature. It happens. People opt in to a new information system, a new communication system, a new commerce system. Will that rise happen, and people around the world just say the utility value is so high, I'm voting with my smartphone, I'm going to participate in this economic system, say the crypto dollar economy, and is it just going to be so powerful that the governments actually, even if they try to stop it, that their citizenry will say, screw you. I mean, that's sort of happened, and those fault lines in areas like communications and censorship and other things have obviously gone different ways in different countries. And I'm very interested to hear both of your thoughts on the geopolitical and political economic implications of this over time, particularly.
I think this will be very disruptive to the extent that there will be regimes that actually topple as a result of this technology, much more so than any other technology we've seen over the past 20 years. It will be a bumpy road, and I think that this technology, there's one kind of view here that this just is a border kind of on the fringe technology, and then there's another that becomes a lot more pervasive in some of these countries. But what's clear to me is that the dollar is definitely the apex predator of fiat currencies. And there's really an insatiable appetite for dollars internationally. And so you see this reflected, look no further than just the yield that you can get on some of these centralized platforms to reflect some of that demand there. Yeah. And there's other studies that you can look at, some of just the on the ground Craigslist style transactions that are happening where individuals are just trying to get US dollar exposure. So I think the dollar as a savings technology actually is a use case here. Where we'll start to see, in how that gets regulated, I'd imagine that we'll start to see some serious clampdowns at the on-ramps in some of these countries.
Yeah. We just launched yesterday with Ripio in Argentina and Brazil. Like, they have a USDC product. You can go from local currency and do it You can generate a 6% yield. It's a seamless experience. You can convert into Mercado Pagos, which is the Amazon of Latin America. So if you need to buy goods, you can do that too. And like, that's pretty attractive, you know.
Super attractive. I guess the question is, does it collaborate or does it compete with the local fiat currencies in these areas? And I think that's where the tension will arise. But you know, part of me really thinks that the genie's out of the bottle here, in the sense that there will be ways to get exposure to this, whether it's through a regulated on-ramp or whether it's through a, you know, meet someone on the street and do a local Bitcoin style transaction, but you're getting access to dollars. And people will seek out whatever kind of savings technology is best. And I do think that this fits into that category of being a great savings technology, maybe to complement things like Bitcoin, which are obviously much more volatile.
Yeah, I mean, same feelings here. We feel that it's going to be very disruptive. The states probably have a certain ability to fight back and try and discourage their citizens from using crypto dollars, but there have been plenty of cases historically where they've capitulated when their populace has said, we don't trust your monetary direction, and we're going to spontaneously opt for an alternative. Mm-hmm. And that's always been the dollar. You've had top-down dollarization, bottom-up dollarization. Ecuador in the early 2000s was a bottom-up dollarized situation. What has impaired or inhibited other dollarization movements, Zimbabwe is a great example. Argentina is another example, is that you had to hold physical dollars. In Venezuela as well. Actually, this is a massive hindrance to the dollarization in Venezuela right now. There's not enough small bills. So you have big bills circulating. It's hard to get smaller change. So it's more challenging. In Zimbabwe, you know, the state was able to kind of arrest the dollarization to a certain extent because there was just a shortage of physical dollars. It's hard to get them in. They didn't have a lot of kind of trade relationships with the US. That's why dollarization's been easier in Latin America. But if you do it in a virtual way, it solves a lot of those problems. You don't have those issues with denomination. You don't have the issue with dollars being captured by large financial institutions necessarily. Like in Argentina, you had the Corralito. Those were dollars in bank accounts that were suddenly, you know, withdrawals were ceased overnight, and then the peso depreciated against the dollar. Those dollars that people thought that they had access to got trapped.
Right.
Now, if it's a bearer style asset, now you don't have to rely on a bank to hold it. It's your own property, effectively. The government doesn't have these high leverage tools to inhibit that dollarization. So it's a much more organic, much more distributed phenomenon. So it seems really different. And it seems like the dollarization events here will be more successful. Mm-hmm. So that's absolutely our view. And it'd be hard to forecast exactly the trajectory there. You can probably name some candidate states where there's a high level of crypto penetration, a high level of mobile penetration, good internet, tech savvy individuals, high inflation rates.
Right.
Those would be the candidate places you'd say, wow, within the nenext 5-10 years, I expect something to happen here.
Yeah. I guess it raises larger questions, central banks on a global scale, or what I would call global scale central bank, call it G20, G10, whatever. Does this ultimately lead to, as this unfolds, does it lead to the potential for a more coordinated approach to synthetic global digital currencies that can exist and denominate new units of account that are actually not just dollars, but that are synthetic? And is this a forcing function on a road towards that? And maybe Bitcoin's even part of that because it's a really attractive non-sovereign store of value, just like all fiat used to have a peg to gold. Like, does a synthetic fiat currency basket with a peg to Bitcoin become a future, the Bancor, does something like that emerge out of this sort of little mosaic we have?
Well, that's where you start to get really disruptive to the United States. And that's where I think that discussion gets really interesting. I thought it was interesting that Mark Carney's sort of parting thoughts at Jackson Hole a year or two ago really had to do with that idea of creating this Bancor-like instrument. In that world, I think that the U.S.'s ability to be that apex predator of money really is compromised. But certainly the incentives to have something like that, if you're one of those G10 countries, certainly exists.
I mean, I would say the issuing the dollar was the quote unquote exorbitant privilege for a while, but it's probably worked against most Americans for the last 20, 30 years. The dollar trades at a structural premium because it's the world's reserve currency, and that's part of the reason the manufacturing has been offshored. Our exports are less competitive. So a lot of Americans don't know this, but I think they would massively benefit from a weaker dollar and something like a Bancor to solve effectively the Triven dilemma.
Yes.
So it's kind of a weird situation where lots of policymakers want the world to be united on a single ledger that basically settles back to the dollar through New York, through the correspondent banking system, because they get all this really granular power projection ability.
Absolutely.
But at the same time, the American middle class gets kind of shredded by the fact that our dollar is so strong. So if, I wouldn't even necessarily object to a weaker dollar. I think it would be kind of in line with welfare maximization.
But I think like there's like this forcing function bottom up phenomenon that could be this catalyst that just forces these big players to kind of get together and think through how to solve for this. That's one dimension, right? There's I think coming back to the very start and part of your thesis, which is, these crypto dollars or let's just say high quality digital bearer fiat instruments or synthetic fiat instruments, whatever these end up being, right? That they very powerfully enable commerce interactions to take place. They theoretically bring the world economic system, makes it more integrated, enables market participants, individuals, creators, laborers, firms, et cetera, to sort of have a different level of commerce taking place. And that, it may be that, the leaps forward that emerge from that over 10 years that also become forcing functions to trying to say, hey, why don't we just get to a different unit of account here? If you read Ray Dalio's recent history books, whatever you want to call it, in these super cycles and in these monetary regime super cycles, and looking at the United States, looking at China, the inevitability of China being the dominant economy in the world in the next 5 years seems like largest at least, and the fact that more trade will be denominated in digital yuan. Those issues might come more to the forefront in 5 years.
Yeah, but the thing is, to replace a global reserve currency, you need an incredibly overwhelming new superpower to underwrite that. It doesn't seem clear that China could do that today. There hasn't been a global realignment as of yet. Often it follows some sort of political turmoil, some sort of transition. World War I was really the event which, took the pound sterling off and installed the dollar. I don't see, that hasn't happened yet. Maybe something will happen, who knows? But if it doesn't seem to me, it's not clear that there's an alternative to the dollar right now. I know everyone likes to predict the fall of the dollar as the reserve currency. Maybe the future is just a number of interlocking currencies that trade can settle in, and some of them politically neutral currencies like Bitcoin.
It would seem to me that some sort of a blended currency like a Bancor would be more palatable. I think the other interesting thing there is just if you think about the ability for the U.S. government to enforce sanctions on a huge scale, and just large swaths of the financial services infrastructure landscape has really become an enforcement arm of the US government in a lot of different ways. And what moving off of a dollar standard would do to that ability to really have visibility into those type of transactions, I think that's a big open question that there will be a lot of pushback if we move towards something that is not dollar denominated.
Yeah, there's lots of questions, lots to unpack. We could go on and on, on all this. Well, this has been an awesome conversation, and would love to continue another time as well. Any closing thoughts? One of the things I always like to ask people is, where do you see this in 2 to 3 years? Where do you see this in 5 to 10 years? Maybe from each of you guys.
To me, I guess the closing thought would be that if you look at everything that we're talking about and how big the three of us think that this is going to be, there are entire categories of companies that don't exist yet to service some of these needs. There are just enormous opportunities here to start businesses. And so that's really what I'm probably the most excited about, is just some of these capital markets businesses, this infrastructure around how to build applications on top of these things, lending and borrowing and payments. So I think it's just a really exciting time to spend some time to get educated about it and see where those opportunities are.
Thank you, Matt.
Yeah, my parting thought is this. So the kind of current financial system as it exists today is very uneven, not just within the US, but internationally, depending on which state you reside in, your kind of access to power. You have very variable access to kind of Western financial rails. And in particular, the US banking system was really the gold standard. And it's a multi-tiered model. And the larger number of hops you are away from New York, basically the more expensive it gets. And that's why you have these really inefficient, expensive remittance channels. So in the near term, I see crypto dollars flattening that topology. And that's already happening. So it's only one hop to get into that global clearinghouse, which is on public blockchains, as opposed to 5 hops. So regardless of the inefficiencies or the high fees or the costs of using a system like that, it's already 100x better. Yeah, because it's a single hop. You get to the global clearinghouse value, you're there. So that is a near-term phenomenon which is not going away. I think it's going to make cross-border commerce much easier, B2B settlement. It's going to open up some of these labor markets which weren't really integrated. I think maybe it'll be, who knows, maybe it'll be bad for the wages of white-collar Americans, because it's much easier to do business with people abroad and hire abroad. Yeah. It may not be net good for Americans, but it'd probably be net good in terms of creating wealth globally. So that's kind of the near term. Longer term, I think we expect and believe that most foreign exchange clearance will start to happen on public blockchains. And right now we're talking about 20 billion free float. That number could be 100 billion by the end of next year easily. The only constraints there are kind of balance sheets of the banks backing them. If you hybridize it with a CBDC and you combine it with access to base money, then there's no constraint whatsoever. So that number is going to grow by at least an order of magnitude, in my opinion, probably more. So, I mean, you look at the pace of growth, and this is still such a small industry. 20 billion, it seems big, but I think it's pretty small in the grand scheme.
Completely agree. And I've been more frequently saying, I can see a world where there's $1 trillion plus denominated in these types of digital crypto dollars.
Easily. There's no constraints on the ledger. The ledger doesn't really have any constraints. It scales with value. Yeah,
absolutely. Well, awesome. This has been an awesome conversation, you guys. Deeply appreciate you coming on, and we'll look forward to chatting again really soon.
Thanks, Jeremy. Thanks for having us on.
Thanks, Jeremy.
Thank you. Absolutely. So fascinating conversation with some very, very bright minds in the space, pursuing and thinking about all of these themes that we're very much enthusiastically working on together. Next week, we're working on a very cool episode. We'll have more to say about it next week. And until next time, stay well, stay safe, and stay informed. Thank you.